Welcome back to the deep dive. Today we are putting a fast food giant on the operating table. We have a square-shaped mystery that is currently baffling Wall Street.
Hmm.
And the central tension here is actually pretty spicy. Are Wendy's famous burgers losing their sizzle for good? Or is the market just, panicking way too hard?
It is a fascinating setup. We are looking at a classic fallen angels scenario. You have a household name, a brand everyone knows, that has suddenly found itself in the absolute bargain bin of the stock market.
Right. So let's set the scene properly. Today is Tuesday, February 17th, 2026. And if you pull up the ticker symbol WEN on your terminal or phone, things look, well, bleak is an understatement. The stock is trading heavily down, hovering right around $6.75.
Which is a massive drop from its highs. I mean, it's a shelf-clearing event.
Sure.
And the headlines aren't helping. We're seeing words like tanked, slump, and mass closures splashed everywhere.
Yeah.
They've just announced a massive dividend cut, hundreds of stores are closing, and U.S. sales have dropped by double digits.
It sounds like a disaster in progress. But, and here's the teaser that hooked me when I was reading through these reports. Despite all that gloom, when we look at the valuation models later in this deep dive, the math suggests the stock might be worth nearly double its current choice.
That is the aha moment we need to unpack.
Yeah.
The intrinsic value calculation came in at $13.61.
Wow.
But the stock is sitting at $6.75.
Yeah.
That is a disparity you rarely see in a company this size.
So the question we're answering today, is this a blood in the streets opportunity where you buy low and look like a genius in 2 years? Or is it a value trap where you buy low and then
And lose everything.
Right.
Precisely.
Yeah.
And just a reminder, our mission here is purely educational. We have a massive stack of research reports, earnings calls from Q4 2025, and financial data to impact the future of the Wendy's company.
All right, let's get into the machinery of it. Part 1, chapters 1 to 3. Business, management, and financials. Chapter 1, business understanding. So chapter 1. Before we diagnose the illness, we need to understand the patient. How does Wendy's actually make money? Because I think most people just assume they flip burgers and sell fries, and that's the end of it.
They do sell burgers, but the corporate entity, the stock you buy, is actually in the business of collecting rent and royalties. It's a franchise powerhouse.
The numbers in the report were wild. 95% of their 7,397 global locations are run by franchisees.
That's almost all of them.
Yeah.
Where it means corporate isn't flipping the burgers in 95% of those stores. They're collecting a percentage of sales as royalties. They collect fees for the ad fund. And importantly, and this is key for the valuation later, they often own the land or the lease and sublease it to the franchisee.
So it's an asset-light model.
Exactly. Think of it as outsourcing the headaches. If the deep fryer breaks in a franchise store in Ohio, that repair bill comes out of the franchisee's pocket, not corporate's. Corporate just collects the check at the top line, the gross sales. Theoretically, this protects them from operational volatility. They get paid whether the franchisee is profitable or not, as long as sales are happening.
Theoretically. But the royalties depend on people actually walking in the door and buying the burgers. And Wendy's whole brand promise is fresh, never frozen.
That is their core differentiator.
Yeah.
But entering 2026, they realized they had a significant problem. They were relying too much on limited-time offers, flashy new items like the jalapeno popper sandwich, and missing the everyday lunch crowd. So the strategy has pivoted hard to permanent everyday value.
Like the biggie bag.
Exactly. The $6 biggie bag, the $4 biggie bites. They are trying to lock in the budget-conscious consumer who feels squeezed by inflation.
And has anything been working?
Well, the one bright spot has been breakfast. That day part is high margin, and their upgraded chicken lineup is actually working well.
Okay, so the model is asset-light. The strategy is shifting to value. Why is the stock at $6.75?
Because of a split reality. We have two very different stories playing out simultaneously.
Okay.
Internationally, Wendy's is a rock star. System-wide sales grew 8.1% in 2025. They're opening kitchens in India, delivery hubs in Canada. The growth engine is humming.
But then you look at the U.S. numbers and it's like a different company.
It's a horror show. The domestic situation is brutal. In the fourth quarter of 2025, U.S. same-store sales dropped 11.3%.
Oof.
That is a massive contraction for a mature brand. That means fewer people are coming in and they are spending less.
That's not just a slip, that's a slide. So the brand is growing abroad but bleeding at home. That explains the panic. But who is steering the ship through this storm?
Chapter 2, Management Evaluation. Chapter 2, Management Evaluation. There has been quite a bit of drama in the C-suite, hasn't there?
A significant amount. We saw Kirk Tanner, who came from PepsiCo, exit the company. Now we have Ken Cook stepping up as interim CEO.
Usually, interim CEO makes the market nervous. It suggests instability or that the board is scrambling to find a replacement. It does. But looking at the sources, Cook isn't just keeping the seat warm. He's launched something called Project Fresh. And despite the friendly marketing name, it is a fairly aggressive restructuring plan.
Right. And management isn't sugarcoating the bad results either. On the earnings call, they admitted they swung too far on promotions and missed the boat on everyday value. But Project Fresh involves what they call the cull, which sounds ominous.
It sounds like a horror movie title, doesn't it? But it's serious business. They announced the closure of roughly 300 to 358 underperforming U.S. locations.
Wow.
That's about 5% to 6% of their total U.S. footprint.
See, when I see closing stores, my instinct is to think failing business. If you're shrinking, you're dying.
It's a natural reaction. But in finance, we call this prudent pruning. Think of a rose bush. These are likely cash-bleeding units that are dragging down the average profitability. They might be in bad locations or have old equipment.
So you're cutting off the dead branches.
Exactly. By cutting them, you make the overall system healthier. You remove the dead weight so the rest can thrive.
Okay, so that's the operational fix. But they also made a capital allocation decision that really hurt investors, the dividend.
The dividend cut. This was the painful pill. For years, people held Wendy stock because it paid a reliable dividend. It was a safe income stock.
Right.
But to preserve liquidity cash on hand, they slashed it by 44%. It went from 25 cents down to 14 cents a share.
And they stopped buying back shares, too.
Completely halted. They are stripping the ship to survive the storm. They need that cash to reinvest in the business and pay down debt, not to pay people to hold the stock.
So it's the responsible long-term move.
But the market hates it in the short term because it stops the immediate payout. It scares away the income investors.
It sounds like they are hunkering down. So let's look at the checkbook and see if they can afford to wait this out. Chapter 3, Financial Health. Chapter 3, Financial Health. We mentioned the stock is at $6.75. The market cap has crashed to about $1.4 billion.
Which puts it in small to mid-cap territory.
Yeah.
It's startling for a brand this famous to be valued so low.
But let's go back to that number you teased in the intro, the intrinsic value. Walk us through the math.
Right. So we use a discounted cash flow model, or DCF. It's a way of calculating the value of all the future cash the business will generate, adjusted for time.
Kind of like predicting the future.
A little bit, yeah. If the turnaround works, and that's a big if, the math paints a different picture. The fair value comes out to roughly $13.61 per share.
$13.61. And it's trading at $6.75. That's essentially a 50% discount. That's like buying $1 for 50 cents.
Mathematically, yes. But there is a reason for that discount. It's not free money. It's hiding on the balance sheet. The debt.
The scary part.
Wendy's is carrying between $2.7 and $3.4 billion in long-term debt.
Wait, hold on. Their market cap, the value of all their shares combined, is $1.4 billion, but they owe $3.4 billion.
Correct. Their debt-to-equity ratio is a staggering 37x. This is extremely high leverage.
What does that mean for them practically?
It means they have zero room for error. It's like having a massive mortgage on a salary that just got cut. If interest rates rise significantly or if sales don't recover, that debt becomes an anchor. They have to pay interest on that debt before they make a dime of profit.
However, I'm looking at the cash flow statement in the report, and it's not all red.
That is the silver lining. Despite the sales drop, despite the store closures, the company still generated about $205 million in free cash flow in 2025.
So the franchise engine is still printing cash.
It is, just less of it than before. But they aren't burning cash. They are still generating it. That is a crucial distinction between a company in trouble and a company going bankrupt. They can pay their bills for now.
Okay, so the business is bruised but breathing. The debt is terrifying, but the cash flow is real. Let's shift gears and see how the rest of the world is reacting to this mess. Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. Chapter 4.
Market sentiment.
Chapter 4. Market sentiment. How is the mood out there on Wall Street?
In a word, ugly.
I figured.
The sentiment is incredibly bearish. You have major downgrades coming in from Morgan Stanley, Goldman Sachs, pretty much everyone. The consensus rating is a firm hold.
Nobody wants to stick their neck out.
No one wants to be the hero who recommends buying a falling knife.
But here's the weird thing I noticed in the analyst reports. Even the pessimists who are downgrading the stock, their price targets are still higher than the current price.
It is an interesting divergence, isn't it?
Yeah.
Even the analysts shouting sell or hold have targets around $9 or $9.80. Remember, stock is at $6.75.
Right.
So even the haters think it's undervalued relative to the current panic selling. They think the market has overcorrected out of fear.
And speaking of fear and panic, let's talk about the short squeeze potential, because there are a lot of people betting against Wendy's right now.
The short interest is very high. About 19% of the floating shares have been sold short. That means almost 1 in 5 shares available for trading is a bet that the price will drop further.
But that can backfire, right? Explain the mechanics of a squeeze for the listener.
Spectacularly. If Project Fresh shows even a tiny spark of success, say next quarter sales are flat instead of down, those short sellers might get nervous. To close a short position, you have to buy the stock back. If everyone rushes to buy it once to get out, the price launches vertically.
So it's a coiled spring.
Exactly. But someone has to trigger the spring.
Mm.
And that brings us to who actually owns this company.
Chapter 5, ownership structure.
Yeah.
Chapter 5, ownership structure. Who is holding the bag or holding the opportunity?
Well, the institutional ownership is massive. Depending on the metric, between 82% and 94% of the stock is held by big institutions like BlackRock and Vanguard.
Standard stuff for a big public company. They track the indices. They don't really interfere.
But the name you need to know is Trian Fund Management. This is the firm run by Nelson Peltz,
The activist investor.
the legendary activist. They own about 7.85% of Wendy's. And here's the thing about activists. They don't like losing money, and they don't sit passively.
No, they usually start breaking furniture if they lose money.
Exactly. Trian is known for forcing change. With the stock down this much, Trian is essentially a sleeping dragon. If management doesn't fix this fast, Trian could force a sale of the company, demand a board wipeout, or push for a merger.
They're a backstop.
They are the ultimate backstop. They won't let this go to zero without a fight.
That gives me a little comfort. And I saw insiders, like the interim CEO, Ken Cook, are buying small amounts too.
They have skin in the game. Insiders own roughly 9% to 13% of the company. When the stock drops, they feel it personally. They aren't just collecting a salary. Their net worth is tied to fixing this. It aligns their interests with the shareholders.
Okay, so we have motivated owners, but they are fighting some serious headwinds. Let's look at the risks. Chapter 6, risk assessment. Chapter 6, risk assessment. What could kill this turnaround?
First, the competition. It's a zero-sum game. If you eat lunch at McDonald's, you aren't eating at Wendy's. McDonald's has deeper pockets. They can run a $5 value meal forever to drown out the competition.
And Wendy's can't match that.
They struggle to match that price point without destroying their margins.
And then there's the macro stuff. We've talked about GLP-1, weight loss drugs, reducing calorie consumption long term.
That's a slow burn risk. But there is a much more immediate, violent risk that popped up in 2025, the tariffs.
This was the detail that really stuck out to me as a potential deal breaker, the U.S. imposed tariffs of 2025.
Specifically, the 25% tariff on imports from Canada and Mexico.
Why does that hurt Wendy's more than, say, a frozen burger chain like Burger King?
Because of fresh, never frozen. That slogan is their brand, but it's also their supply chain bottleneck. You cannot stockpile fresh beef in a freezer for 6 months to hedge against price spikes.
They need it now.
You need a just-in-time supply chain.
Wow.
Where does the beef come from? Well, the U.S. cattle supply is currently at historic lows levels we haven't seen since the 1960s. So the industry has to import lean beef from our neighbors, Canada and Mexico, to blend for burgers.
So Wendy's has to import beef from the places that just got hit with a 25% tax, and they can't store it.
Exactly. They are exposed to the spot market. They have a trap. They either eat that 25% cost, which destroys their already thin margins, or they raise prices on the menu to cover it.
But if they raise prices, they lose more customers to McDonald's.
Precisely. It's a brutal operational squeeze. That fresh promise is currently a financial liability.
That is a tough corner to be in. Okay, we've looked at the good, the bad, and the ugly. Let's wrap this up. Chapter 7, conclusion. Chapter 7, conclusion. How do we synthesize all this? Let's start with the bull case. Why would someone buy this stock at $6.75?
You buy it because it is mathematically cheap. You are buying a global brand at a 50% discount to its intrinsic value. You believe that the international growth is real and will eventually outweigh the U.S. slump.
Okay.
You believe that prudent pruning of bad stores will fix profitability. And crucially, you believe that Nelson Peltz and Trian won't let the ship sink. You are betting on the turnaround.
And the bear case.
You stay away because you think the brand is broken in America. You look at that 11% sales drop and say, customers have moved on. You look at the $3.4 billion debt load and see a bankruptcy risk if rates tick up.
And the tariffs.
And you look at the beef tariffs and see a business model that simply cannot work in the current trade environment. You see a falling knife that will cut your hand if you try to catch it.
It really is a binary outcome. It feels like it goes to $13 or it goes to, well, zero.
It is a classic high-risk, high-reward turnaround play. It is cheap for a very good reason.
Here's my final provocative thought for the listener. We talked about how they own and lease a lot of property. With the stock price this low, $1.4 billion for the whole company, and the real estate assets being that valuable, will Wendy's even exist as a public company in a year?
That is the ultimate question. A private equity firm could come in, buy the whole thing just for the land, strip the assets, and take it private. It might be worth more dead than alive on the public market.
It's happened before. Well, that's a lot to chew on.
Indeed.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
Thanks for listening.